What's holding up is the Hong Kong market. That's seeing a gain of over 1%.
There are recent developments that concern a few banks that I'm monitoring very carefully.
They've actually said that the group has fully prepaid all of the share-back promoter financing that they had earlier taken.
RBI has granted a 2-year extension to MD and CEO of IndusInd Bank, that is Mr. Sumant Katpalia.
Flat for the Sensex, flat on the Nifty. The midcap index is taking a bit of a knock, so don't lose sight of that.
You've seen the rates have gone up quite sharply, and that will have some impact in terms of growth.
Both companies for us are, very profitable businesses generating positive cash flows.
Our view was that, the challenges at SVB were probably idiosyncratic in that the broader banking sector in the U.S.
The mid-caps and the small caps have sold off aggressively.
Yes Bank, a bank almost on the verge of collapsing, was saved by RBI thanks to capital infusion from other lenders.
Experts that we chatted with said that they had startup-friendly policies. So many United States banks, US banks, were unwilling to lend to an Indian startup because some of them had no employees in the United States.
We are at the low point of the day. We're seeing a 160-point cut on the Nifty.
Okay, it's a dark, deep red day for markets this Monday afternoon. You're with us here on a new edition of Closing Bell. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Guys, hi.
Hi, what a reversal, right? From the markets, 350 points off from the top.
I mean, this is a bit surprising because, you look at global markets, you look at a lot of other markets, it's not visible. I mean, this kind of panic is not visible anywhere, at least not in US, right? I mean, if this is basically a problem out of the US, I mean, US assets should be hit hard. They were on Friday, but right now they're actually higher. The graphics will come up. Just first things first, the Nifty, by the way, has broken below the February lows of 17,255. The Bank Nifties, I mean, as we start the show, it's almost there. We're at 39,662. The low is 39,600. So we're almost there for all practical purposes. Now, let's just explore the reasons, right? I mean, a lot of people are asking what is going on? What's the reason for the market to sell off so aggressively? There are legitimately some fears that there could be more small regional banks in the US where problems could show up. It's possible, right? I mean, for example, there's another bank called First Republic, which has been selling off for the last couple of days. Again, a small regional bank like the Silicon Valley Bank. Fair enough. I mean, it's possible. As they say, there's never sort of one cockroach. So there could be more trouble, which we could learn about newer names over the next couple of days. But look at the market in the US. US equity futures are higher. Yields have crashed, another 16 basis points lower, and the dollar is completely sold into. We started with the dollar at about 104, almost 104.4 in the morning. We are sub 104 right now, 103.95. So, the classic signals or markers of any sort of panic, that is not there, at least not out of the US market. Now, Asian stocks ended higher, Europe is down. But mind you, Europe has done very well. As a region, equity markets have done very well. So this could be some amount of profit booking which we are seeing. Markets like UK, etc., for example, have outperformed the US by a very large margin. So keep that in mind. Which then gets me to the last remaining possible explanation, which is FII selling, right? I mean, I know it does. It's like a fallback reason, but I can't think of anything else why markets here, given what we know, the information we have, should sell off like this. FIs have been selling at higher levels. They were big sellers of some 2,000 crores on Friday, and adjusted for block deals, of which there have been very large numbers this month. Net, they've been big sellers in Indian stocks. And I think that perhaps explains. And this is nothing new. This is a continuation of the rotation out of best performing markets like India, which started towards the end of last year, which continues. I said this in the morning, and I think, so far one can say this, fundamentally, there is no real reason for a big market move. I mean, either up or down. On the ground, perhaps there is a bit of slowdown. We all know that. Companies tell us that. But is it very severe to warrant? Fundamentally, has anything changed? I don't think so. But we'll see. Sometimes reasons take time to show themselves to us. Maybe there is something which we are missing. But from what I can decipher, this does seem like a bit of an exaggeration. 1.5% now on the benchmark indices. Rima.
Hi, 17,150 on the Nifty, 260 points lower. The Sensex is now approaching a 1,000 point cut, 900 points lost plus on the Sensex. But, on the point about the Dow futures in the morning was up about 300, 400 points. As the European markets opened up, and they opened with a deep gash of 1.5%, the gains on the Dow futures also trimmed. So currently the Dow futures is only up about 150 points versus being up about 350, 400 points earlier. So I suspect as, we get to actual US morning and, people wake up, that rate may change on the Dow futures, because Europe right now is, deeply in the red. It's down more than 1%. The problem is the way the broader markets have also sold out in India. The midcap index is down more than 2%. That's a similar cut you are seeing across the small cap index. The advanced decline ratio is 1:6, which means for every one stock which is in the green and holding up, you've got 6 stocks which are in the red, with more than 2,500 stocks under pressure. Most of the sectoral indices are, weak in trade. You've got deep cuts in IndusInd Bank. Auto names like Tata Motors, M&M, Infosys is selling off rapidly. 2.5%, 3% gone now. In the banking pack, Axis Bank, State Bank of India under pressure. The loan gainers, 5 of them only in the Nifty holding up. You've got Tech Mahindra leading the charge and Adani Enterprises, and then throw in an Apollo Hospital, ONGC, Power Grid. And the list of the gainers ends with that.
What a day. And we have made fresh lows on the Nifty Bank as well. The Nifty lost the February lows about an hour, 45 minutes bank, and the Nifty Bank has just done that. It's breached that level of 39,600. Prashant, I just want to point out one more thing. Remember in the morning we were talking about the dollar pulling back, the dollar index. Pull up the dollar index now. It's again moving to the 104 handle. In the morning at around 8:30 our time, we were looking at 103.7 thereabouts. There's a move on the dollar again, 104. And there's a massive rush for US treasuries. The 10-year yield is collapsing. And Prashant, I think right now people are going and buying bonds, irrespective of what the rate situation is. You run to the dollar, you run to US treasuries when you think there's uncertainty, when there's fear in the market. These two are the best gauges, really. US government bonds and the US dollar. That's what people run to in really uncertain times. And that's really playing out. Look at the 10-year yield. I mean, we're talking 3.5 now. We're talking 4 plus. Just 7 or 8 sessions ago, everything has turned on its head. And the other bank that Prashant alluded to, I think in after hours trading, those shares, First Republic shares, are down about 60-odd%. So there's a fair amount of panic going on. And I think, Prashant, the one point that's being debated is that in the UK, you got HSBC to, for what it's worth for £1, but you got another bank to buy out SVB's UK arms. In the US, that's not happened. Ultimately, it's the government that has stepped in to provide a backstop. Now, you can say it's not taxpayer money. That's a separate moral debate. But they did not find a bank or weren't able to convince a Wells Fargo or a JP Morgan or one of the biggies to say, okay, don't worry, we're buying them. Everything's okay. I mean, we're solid enough to digest this and move on. The government had to step in. And I think that says something in itself. But we can only hope. We can only hope that it kind of stems here. But the screen seems to be indicating a fair amount of nervousness, at least as of now. Yeah, it does. But Surabhi, it's always very difficult to decipher reasons why things are moving the way they are. On the rates, I would just say this. I think there could be some people could be rushing to buy bonds. I mean, it's possible. But I think more than that, what's happened is that people have repriced expectations of what the Fed will do. I think that is the bigger kind of driver here. And that is not a bad thing, right? Yeah. Goldman, I think, went on to say that no hike in March, maybe in May. In 5 days flat, from expecting 50 basis points, now people are saying maybe they won't do anything in March, right? So I think that is what is driving at least the front end, the 2-year, the 5-year, etc. in the US right now. Actually, let's just quickly get Mitesh in as well. Mitesh, of course, got it bang on in the morning. He was saying sell the bounds, and boy, has it worked out. Mitesh, what does one do now?
That is the bigger question, Prashant. I think you've already made some profits on the short side, and I'm not very sure these are good levels to initiate fresh short positions on the index. So I think take profits, wait out for another intraday bounce back if you get it. But otherwise, try to proxy play the index by, exploring stocks which are breaking down afresh or which are not trading below support levels. I think that could be a fair way to proceed. On the index, I think, we had talked about target of around 17,100 to about 17,050. We are not We haven't actually met those levels per se. But I think it'll be prudent to take, let's say, if you've shorted in the morning, or maybe you had shorted last week Friday with the gap down, it'll be prudent to take at least half the profits off the table and now trail your stop loss about 17,240 on the spot level. So that's the way we are approaching it. And on the stock side, Ashok Leyland is something which is on the radar. It's given a big red candle with volumes, and the overall setup is turned negative. So recommend to sell here with the stop at 144 and target of roughly around 133 to begin with. And also a sell on Oro Pharma, which I would recommend selling with a stop at 453 for targets of 430.
Okay, Ashok Leyland, Oro Pharma. Thanks very much, Mitesh. Stay with us. We'll keep coming back to you through the course of this show with the markets what they are. Almost 290 lower. N. Jaykumar is with us, Managing Director at Prime Securities. He's seen a lot of market episodes like this one. Jake, it's great to have you with us here. Good afternoon. I think people, first of all, just want to know what's going on. Why do we have a 300-point cut on the screen on the Nifty? What is the dominating driver, really? What is the worry here in India?
I think uncertainty more than anything else. At its most basic form, this is a bailout of a pretty high order. Where a bunch of people violating every norm there is between asset liability mismatch, putting overnight deposits into 30-year bonds and getting a bailout where essentially a put has been sold to them by the US government to put back bonds that are trading at 60s and 70s and to put that back to the US government at par. I mean, if there is anything more immoral than this, I haven't come across one. And it may be practical. It may be what the market wanted, but I think it's also come home to roost that the US government has more problems than just tackling inflation, because in their bid to sort of zealously attack inflation through interest rate hikes, they've realized that there are cracks in their, multiple sort of structures, if you will. And this particular thing, which handled all kinds of early stage startup money, unfortunately, it's also linked up to this. And look at the paradox of this entire thing. It's startups which essentially have raised money. That money has gone into these banks in the valley, and those banks have actually put that money back into bonds. So this is some kind of a veiled funding of the US Treasury bills, if you will. These guys had no business to be in that market. They were there, and now they're getting bailed out at par when these are, when a $26 billion loss is staring them in their faces. So this is an odd kind of situation, but it's also telling you that the US is realizing there are more chinks than they had bargained for. There are more issues to be addressed than had been previously articulated. So I think, one, for starters, this uncertainty has led market people to believe that there could be more problems coming up, and rightly so. You may have one signature bank, some other bank, but the bottom line is the process has started. Having said that, whether you want to bail out through, whether you want to spend money through bailouts like this, or you want to keep hiking interest rates and hurt the economy in general, that's a question that the US is now faced with. And I don't think there are easy answers here. Though I think what will happen in the short run is interest rate hikes will either stop or get dramatically moderated. Because one thing is very clear, the markets are telling you that the world is moving towards safety, not in terms of the US dollar, which actually is now conclusively below 104, but they're moving more towards the US T-bills as a means of safety. And if that happens, I think the markets are presaging a drop in interest rates, and therefore this logically should be good from an equity market standpoint.
But right now, at least, there's so much uncertainty, Jaykumar, and people fear that this could just be the tip of the iceberg. 3 banks in the United States, 2 of them crypto-focused, are under pressure, folding down, wobbling, and that's, just got people worried that we could be at the tip of the iceberg. But do stay on. Let's get everyone up to speed about the latest in the SVB saga. HSBC is all set to acquire Silicon Valley Bank, UK, with British Chancellor Jeremy Hunt confirming the sale. But will the sudden and dramatic collapse of SVB make the Fed rethink its pace of rate hikes? That's the question every trader is grappling with. Lata is here with what economists and in the key brokerages are saying. Lata.
Okay. Well, thanks to the collapse of SVB and the jittery state of other banks like Signature, economists are beginning to pencil in fewer rate hikes from the Fed, but the street is deeply divided. Goldman Sachs is at the one extreme end, expecting no hike at all in the March 22nd meeting, but it is seeing one hike each in May, June and July, taking the terminal rate to 5.25 to 5.5. But Goldman Sachs is adding in its report there is considerable uncertainty about the path, about the future path. Now, Citi is at the other extreme. They spoke to CNBC TV 18, and the global economist Robert Sorkin said they continue to expect a 50 basis point rate hike on March 22nd and a terminal rate of 5.5 to 5.75 with risks to the upside. That is, even 6% is possible. Now, Sorkin told us he thinks SVB is an idiosyncratic case and that the US banking system is healthy, big banks have high capital. Also, on the economy side, payrolls data showed that the labor market is strong and the Fed wants to see it slow down. Labor market and inflation data will dominate the Fed's thinking, he said. Banking stability will be a marginal concern. That's Sorkin of Citi. Nomura analyst Sonal Verma continues to expect a strong CPI data that comes on Tuesday evening and hence a 50 basis rate hike like Citi from the FOMC on March 22nd. So Nomura maintains that 50 basis hike call, but they again add the same phrase: uncertainties have increased. Morgan Stanley's Ellen Zentner and others, writing on Friday, said that they are continuing to go with a 25 basis hike unless this week's, that is Tuesday's core CPI, comes in higher than their estimate of 0.38%. And finally, what does the broad market expect? As per the CME Fed Watch tool, currently 93.7% expect a 25 basis hike. That is up from only 59% who expected that on Friday. And guess what? 0% expect a 50 basis hike, down from 40% who were expecting 50 bips hike on Friday. By the way, I must mention a minor 6.3% expect no hike at all. So the confusion is complete.
Well, so much can change over a weekend, right? Lata, perspectives were so different just around, Thursday or maybe early Friday, and then the world's a different place today on Monday. Jakes, hi, good afternoon. Surabhi here. So, before we start talking about the Indian market, just on the US, what do you think can stop the panic? The US government has come out saying we're standing behind all depositors. Then there is this new term funding facility that's been opened. Some new fancy name has been coined. It's basically a one-year, loan arrangement that the Fed is providing. This other bank, here they have a credit line, I think, even from JP Morgan. Markets are still roiled. They're doing what they are. So what can stop this and what can start that equity rally that we've seen in the previous instances? Every time once the Fed comes in and starts cutting, that's when equity markets take off. Will it be somewhat similar this time?
Well, I don't think we can talk about cutting just as yet. I think we need to have a couple of meetings where they actively sort of talk about the fact that they are worried that this relentless increase in and the pace of increase of these of interest rates has ripple effects which they are not bargained for, based on which they'd rather err on the side of caution and not increase rates. That has to be the first step before they move to the next step of saying, go through maybe 2-3 meetings of no interest rate hikes. And that's probably what the market is almost forcing the Fed hand as we speak. The Fed hand today is driven by not just the cost of bailout. Please understand, the US government has $21 trillion in debt. Compared to a year and a half ago where they were servicing this at 1% effectively, today you're servicing it at close to 4.5-5%. That's an increase of $600 to $800 billion a year. Or put it differently, it's a $1 trillion of interest liability per year that they have to service. So is it that cost that they bear, or do they bear the cost of bailouts? That's the big question. And my own feeling is the markets will force their hand to keeping and the markets are presaging that interest rates will not rise any further at the same pace at any rate, and probably peak out maximum one rate hike of 25 basis points and then a peaking out is probably the way I see this. And I wouldn't rule out the possibility of even no hike a few days from today.
You know, the debate about what's happening in the US is it throws up opportunities for a very rich debate, right? I mean, there's so many angles to it. So, but for a viewer here, Jakes, what does all of this now mean? You know, we're at what 17,150. Is there significant downside from here? When I say significant, I mean another 400-500 points, or you think you know this is it? These are good levels. What's your sense?
Even the last time I was on your channel, maybe a month and a half ago, I did talk about a 17,000 to 17,300 as being the sort of base for the moment. I mean, one way or the other, excuse me, it seems to be there. I would think it's a good level to be picking up, you know, specific stocks in specific sectors. We, for instance, like integrated the metal sector, the integrated players. We like PSU banks at these levels. We think that capex and industrial private capex-led industrials, maybe defense, this is the way going forward. And you have to stay away from the overall, you know, consumption themes, FMCG, technology. So at one level, the unloved, underowned, but possibly rich in value stocks will be the ones sought after. And you need to be a contrarian, because if technical levels can, you know, make people sell, then you could have fair amount of chaos in the market without any fundamental reason. But markets don't bottom out with logic always. But I do believe that index-wise, these are good levels to enter, especially in the spaces that I talked about.
Do you see any reasons for the markets to move decisively lower, well below 17,000, perhaps head to levels of 16,000? Are there any triggers in the near to medium term which could take us down?
If triggers were there, it would have already happened by now. So I think I wouldn't say that there are triggers that we are aware of. But, you know, right now the banking sector issues seem to be concentrated amongst a few smaller names. And that may well be the silver lining, but sometimes that is, you know, as they say that akalmand ko ek ishara kafi hota hai. So in a sense, if the Fed, which is a smart bunch of people, can take this as a sort of early warning that further rate hikes could pressurize other sectors. My own sense is that that may be the route they take. So I think we've got to, you know, never mind what social media talks about people in the US, you know, and this jingoistic talk of saying, you know, look in your backyard before you advise us what to do, kind of nonsense. The reality is some smart people are there, and they realize that, in my opinion, that's why the speed of action of keeping depositors protected, you know, literally in 24 to 48 hours. So from that perspective, I think there are, you know, a good bunch of smart people there managing affairs. And my personal feeling is they will opt for a more cautious orientation towards interest rates. And that could well mean, as I said, a max of one interest rate hike of 25 basis points and no more beyond that.
Got that, Jakes. By the way, the bank Nifty is looking at this crunching 900-point fall. Bank started to sell off on Friday as well. Not that there is any connection between what's happening in the US and here in India. But anyway, Bank Nifty and big banks leading the fall. So, Jakes, before we let you go, what is the advice? At some point, you know, if that scenario plays out that we've been discussing, that the Fed gets into a pause and gets a little more benign in its outlook, then how does one prepare for that? And in terms of portfolio shifts, what do you do? Do you buy down some of these beaten banks? What else? Earlier, the market had a very clear disposition towards government capex. So I'm just asking, what's the portfolio shift to make over the next couple of weeks as we perhaps get into that scenario?
As I mentioned, public sector capex is visible in defense companies. It's also visible in some industrials in that sense. Private sector capex is visible in steel. It's visible in cement to an extent. And I think if you go by history, the 1 year in the run-up to general elections and the couple of years thereafter is usually the best period to invest in capex and capex-oriented and industrial stocks, because that's where the maximum offtake, maximum number of projects, etc., are awarded. So from that perspective, that's the space to be in. It's a space which currently is underowned. Perhaps defense has seen some ownership shift, but that's also not institutional as much as it is HNI and trader driven. But all the other spaces have seen only tactical action, nothing strategic. There's been no big shift of money into the spaces that I talked about. And from that point of view, the under-owned spaces offer some degree of respite. I'm not one who's necessarily worried about FIs selling, because the same FIs who take tactical positions against also come back to cover. So that's neither here nor there. I think fundamentally, retail individuals, if they continue with their SIPs, I think are probably better suited to and better advised at this point in time. Because if you've been putting SIPs in over at higher levels, there's a time you should not. Usually the SIPs stop at times like this, which indicates that people buy into frenzy but don't buy into despair. And that's exactly the wrong thing. So from that point of view, I think I would say from an individual point of view, SIP should continue. And from an institutional point of view, some of the beaten down sectors will offer solace. But beyond all of this, I think the reality is that the dollar index is on a decline, and activity in China has taken off in a big way. The Chinese premier has reinforced that time and again in the last few weeks. And from that perspective, between China and India, I think the world will start looking here. This, ladies and gentlemen, may well be the place to focus on. And emerging markets could actually be the place to derive some solace for global equity-oriented funds.
Okay, all right, Jakes, thanks very much. Good speaking with you. Appreciate you joining in with that perspective. As Jakes is saying, as has happened so often, will markets throw a tantrum big enough, forcing policymakers to back off and do their bidding? It's happened before, it could happen now. Look at the rupee, which is now given up all the gains. It was, it was 1/3% gain in the morning against the dollar. It's completely reversed, and we are now actually almost unchanged on the day. So 82.085. This is quite something. We'll slip into a quick break and we come back on the other side. But just a quick programming note. Tomorrow, on the 14th of March, CNBC TV 18 will host what will be India's largest summit on gender parity in Delhi. Women leaders from all walks of life will come together to brainstorm and help take decisive steps to bridge the gender inequality that exists in India and across the world. The event starts at 4:30 in the evening. You can all catch the event live right here on CNBC TV 18.
Well, apart from Tech Mahindra, there is no other stock on the Nifty that's up even 1%. That's the extent of the fall today. Tata Motors, M&M, quite a few of these auto names have been down right from the morning. And obviously, the pain and pressure is only more severe now. Reliance is down almost 2% as well. Okay, let's take the conversation forward. We have Dilip Bhatt joining in. Dilip, always a pleasure to have you on the shows. What a day. I think what has unnerved a lot of people in the market is the ease with which a lot of levels just got broken. You know, the moving averages, the February low, the Bank Nifty also broke the February low. Your thoughts on what we've seen today and how you'd navigate the market next few days?
Well, I think when there is a panic, everything else takes a back seat without any doubt. And I think that is what we have seen, complete capitulation of most of the levels and most of the support levels. And I think what we are seeing at the moment is, even if there is no great selling, but there are too many moving parts in the market, whether the Fed is going to increase the rates or they're not going to increase the rates, or what's going to happen to the American banks. I think all that is playing a very contagion impact, is having a very contagion impact on the fears in the minds of the people. And possibly, I think typically when this kind of panic happens, I think we will see a complete sell-off, which is what we are seeing. From my perspective, I will still think that the larger part is that as the quantitative tightening is happening, whatever panic that we are seeing, markets are getting recalibrated and fees are coming down. And that is possibly, I think it will culminate into that. and we may the situation will be completely it will be so strange that Indian companies are doing well and the price is not going up. So maybe we may not see great fall from the current level, but a lot of time spending on the sideways, that looks very much a possibility.
Okay, so you don't anticipate a big fall, but markets consolidating and spending some more time correction at these levels. Dilip, we've just had a very long period of time correction already, but do stay on. We wanted to get your thoughts in on IndusInd Bank, and that's selling off. The RBI has approved the extension of the current MD and CEO Sumant Katpalia, but he's been given an extension of 2 years, but the board wanted 3 years. Abhishek is here with the details. Abhishek.
Well, Rima, as you mentioned, RBI has given an extension of 2 years to the tenure of Mr. Sumant Katpalia as MD and CEO of the bank. Now, his current term was to end on 23rd March 2023, and the board had sought for a 3-year extension. However, 2 years is what RBI has approved of. Brokerages say that the move from RBI has come in as a negative surprise. However, they say that the valuation of price to book value of anywhere between 1.2 to 1.4 on a 1-year forward basis is actually on the cheaper side. So one can use this correction to add the stock in their portfolio if at all they need to, due to no risk on the fundamentals of the bank. So brokerages like JP Morgan have downgraded the stock to neutral from overweight. The target price has been cut to 1,060 from 1,400 that they had earlier. Even Jefferies have actually decreased their target price on the stock by about rupees 50 to 1,550 per share. Otherwise, Macquarie, Citi, Morgan Stanley, as well as Motilal, all of them remain bullish on the stock, and the target price ranging from as low as 1,420 to as high as 1,525, on the stock. However, one needs to also look on the fact that, there are many other top positions of various lenders which could get impacted or which could see a seat change in this year. So other lenders where the seat can change if at all the tenure is not extended is City Union Bank, AU Small Finance Bank and Karnataka Bank. Their current MD's tenure is ending in April 2023. For ICICI Bank, SBI as well as HDFC Bank, the current MD's term is ending in October 2023, while for Kotak Bank, Mr. Uday Kotak's term comes to an end in December 2023. Back to you.
Thank you very much for that. Let's quickly take stock of Tech Mahindra because that's bucking the trend on the back of the leadership change. Stock is up nearly 7%. The change is that Tech Mahindra has announced Mohit Joshi from Infosys as the CEO designate of Tech Mahindra for a period of 5 years starting December of 2023, which is when CP Gurnani's term comes to an end. The street likes the fact that the uncertainty has come to an end, and they also like the credentials of Mohit Joshi. He was the president of Infosys. He was handling the BFSI and healthcare sector. He was also in charge. He had executive responsibility of all the large enterprise deals. This appointment by Tech Mahindra also indicates that the company, the management now wants to focus on the non-communications business. Tech Mahindra historically has been associated with communications, but now there appears to be a bit of a change in strategy because Mohit Joshi is a non-communication, non-telecom guy. So that's point number one. And secondly, as I said, the street likes, the pedigree, which has been pedigree of Mohit Joshi. The risk associated with this is that turnarounds take time. Catching up with industry growth rates takes time. It takes 2-3 years. In the near term, there could be some margin dilution as Mohit Joshi decides to make a lot of investments to boost the digital capabilities of Tech Mahindra. For Infosys, it's a bit of a blow because in the last 6 months, they've lost Ravi Kumar, another president to Cognizant, and now they've lost Mohit Joshi to Tech Mahindra. Dilip, your view on Tech Mahindra, and do you see a CEO-led turnaround in this case?
Well, I think this was much awaited and anticipated by the market that we will see a change in the leadership. And I think this leadership change is certainly very favorable for for improving the perception further of Tech Mahindra. Without any doubt, I think it's trading pretty cheap. I don't think, if I'm correct, it's just trading around 12 to 13 times FY24. And I think from that perspective, also on a risk return basis, there is very little downside. Yes, of course, the turnaround by a new CEO will always take time, but I think people are ready to bet behind that. And it's all about future discounting. So I would think that on a risk return basis, one should buy Tech Mahindra for a period of 12 to 15 months for at least 20 to 25% depreciation from the current levels.
Got that, Dilip. Stay with us. What we'll do is we'll take a... Okay, what we'll do is we'll go across to our colleague Nimish, who's standing by on D Street Chat. And Nimish, I think, what people want to know is what is the kind of institutional selling which is going on, right? FII selling. So let's start with that. What are you picking up?
Hi, Prashant. So as far as the flows are concerned, I don't think, there is a large sell-off. That at least that's not the feedback that I picked up from the daily rooms, that there is a massive selling from the larger FIs. Do remember today's numbers will be marked by two large block deals, where, there were two large blocks, and I guess on both the sides, the sellers were not institutional. So it will be marked by very large, number because of the two large block deals, which is Sona Comstar and Mahindra CI. I think that's going to have an impact on the institutional numbers. But as I said, there is no feedback of very large sell-off. I think, again, the markets are at day's low. Some very crucial support levels are broken. But I guess there is no reason, nobody can point to a specific reason why India is underperforming so much. I guess it's largely to do with global risk-off, and that's putting an impact on the Indian markets as well. The pain point is the financial space. The entire banking Nifty is down 2%. Most of the stocks are under pressure today, and that's been a big pain point. Also, some of the large heavyweights are not supporting the Nifty or on the bank Nifty. So that's been the big talking point, and a big pain point is the overall feedback. I guess, as I said, some crucial technical levels are broken. So below Nifty is below 17,200. That was a big support, and now that's taken out. So now people are talking about 16,800 could be a level to watch on the downside for the Nifty. So that's the level. Even on bank Nifty, some crucial levels are broken down. So that's the reason why there is a bit of panic as well, I believe, in the second half of today's session. But short answer, Prashant, whether there is a large sell-off from the larger FIs, the feedback is no. There is no big selling pressure from the larger FIs, especially in the large names or in the cash market.
Okay, got that. That's a point well taken, Nimish. By the way, so much selling pressure on financials beyond the index as well. Look at names like L&T Finance, Max Financial, Aditya Birla Capital. Anything relating to finance is being sold off. But Nimish, you tell us, what are the other stocks on your radar today?
Hi, Surbi. So in terms of individual names, the first stock on my list today is Polycab. That stock is under pressure today. Even on Friday, that stock was on 4%. And the biggest worry is there is a buzz of a large block coming soon in Polycab, and hence that stock is under pressure. So that's the first one. The second stock is Piramal Enterprise. Again, that stock has almost hit a 52-week low today, been a massive underperformer. And even at these levels, the feedback is there is constant supply coming in from larger FIs. So the delivery volume is expected to be quite high in Piramal Enterprise today, and there is selling pressure from larger FI is the feedback. So that's the second one. The third stock is Hindustan Lever. Broadly, the feedback since morning was there are buy flows in the FMCG stocks. And within that, Lever stands out. There is a big announcement of the new CEO, and there is a fresh buying as well. So this dip is largely getting bought by some larger FIs in Hindustan Lever. That's the overall feedback. And the last stock is TCNS Clothing. Again, in a weak market, that stock is up 6%. There has been constant reports as well of a possible deal of a stake sale. So maybe that's the reason why that stock is excited today. And the feedback is that maybe by end of this month, you will see that transaction going through, and hence that stock is buzzing in trade today.
Thank you very much for that. Get into a break. On the other side, Jonathan Sheasel of Westminster Asset Management will be joining in. Welcome back. India is not alone in this excruciatingly difficult sell-off. We are currently down 1.5%, Nifty below 17,150. The Sensex is now down 1,000 points. But just take stock of the European markets. European markets opened with a cut of 1%, but they've now extended the sell-off, and the key European indices are down 2.5%, extending up to 2.8% on the German index, the DAX. Individual stocks, banking names in Europe have been hit hard. HSBC shares are down 3.5%, Commerzbank down 12%, Credit Suisse has slipped close to about 9.4%, and one of the key indices there, the banking benchmark index, is down more than 4%. Just take a look at the US futures. In the morning, the US futures were up 400 points, but now the Dow futures is down 75 points. So from the day's high, the Dow futures has slipped more than 500 points. The S&P 500 futures is currently down 1%. So the sentiment on Wall Street, which was positive in the morning after Janet Yellen said that she's going to be protecting all the depositors, that sentiment has now reversed, and there is clearly risk off across the board. For our market, the slide continues. The Nifty Bank is down 1,000 points. Mitesh, any trades in the index? Sell-off is overdone. Do you see that we could sell off more, and therefore you would have the confidence to take a short position?
On the index, it's difficult to guess because after this kind of a cut, you can always get last half an hour of covering or 20 minutes of covering, or maybe a gap of 2 hours or something the US market says. So I think not shorting of fresh levels. We in fact suggested taking part profits off and trading the stock around 70 to 40 to 35 levels. Having said that, I still on the stock side trading negative bias. So I have HDFC Life. That's making a fresh low. That's SCBT, and here I'm looking at a stop loss at about 480, 485, and a target of around 470, 468 for tomorrow. And HDFC Bank was a sell call on Friday. Now SCBT can be taken here. The stop at 1580 for target to 1545.
Mitesh, thanks for that. Stay with us. We'll come back to you before close once more. Jonathan Sheasel is with us. He's Deputy Chief Investment Officer at Westminster Asset Management. Neeraj Diwan is also with us. He's Director at Quantum Securities. Gentlemen, good to have both of you here. Jonathan, the way banks are selling off, sometimes these become self-fulfilling prophecies, right? I mean, you keep saying this will spread, it spreads. And especially true in banking, actually maybe only true in banking. I'm looking at stocks in Europe, and we were just mentioning this 5, 6, 10% lower. And suddenly the world will look very different. I hope we don't go there. But what's your sense? How likely is it that we get a sort of broad banking contagion? I mean, a bigger event. SVB was one bank, but this seems to have spread very fast. Go on.
Yeah, look, I think the issue probably, yes, SVB is a trigger, if you like. I think a lot of us have been thinking markets had been, up to a couple of weeks ago, incredibly buoyant and being somewhat complacent with what the message coming out of the US, the Federal Reserve. And I think we were looking for some sort of catalyst or some sort of event that perhaps would crystallize, what the next move lower to reflect the sort of fairly hawkish tone coming out of the Fed. And I think, anybody with experience of 2008, I think the result is you sell first and ask questions later. And it feels very much like that at the moment. I think authorities have acted very rapidly to stem the contagion. But I think, obviously people are just thinking, well, we had all this many, years of effectively free money. What else is going to crop up out there that we're not expecting? And we're in that sort of phase at the moment. I don't think this is at all anything like what we saw back in the global financial crisis. But clearly, futures were up, as was pointed out a moment ago this morning, on the back of this perhaps signaling that the Fed will now have to ease back their tightening rhetoric. But yeah, for the time being, this is probably just a sell first, ask questions later type sale. And we certainly don't see this as broadening out into massive financial contagion just yet.
Well, Jonathan, good afternoon. Absolutely. I mean, I'm going back to that time, 2008 as well. Right now, this seems to be turning into a market-made crisis of sorts, because back then we actually had bad debt. We had securities packaged and there was a whole domino effect. There was bad underlying debt with people not paying up mortgages, which was at the center of that crisis. Here, we probably have an asset liability mismatch at one bank. Obviously, startups in the Silicon Valley not getting easy access to funding. But what's happening right now with the market showing absolutely no confidence in moves from the US government or the US Federal Reserve, could this really spiral out of control? I mean, what should we brace ourselves for over the next couple of days?
Yeah, as I just said, it's interesting to note that this isn't, obviously the Bank of England and what happened in the gilts market a couple of months back, you could argue is the first sort of shot across the bows of what, this liability mismatch or, duration mismatch. And this is, obviously what we've seen recently is the second sort of coming of that whole problem. I think obviously, as I said a moment ago, this era of very low interest rates and cheap money, that's clearly been at an end for a while, and we're still seeing the consequences of that sort of running through the system as the system adjusts to the world of higher interest rates. We don't think it is a contagion that will spread, but clearly markets are not in the mood to listen to that. They're selling first, taking a little bit more risk off the table, and then they'll want to see what authorities do, what the Fed says as well. So I think the next few days will be very important, but I think there will probably be some calming noises out the Fed later on today.
Yeah, to quote one of our earlier guests, literally forcing the Fed's hand. I think that's what markets around the world are literally trying to do.
Okay, let's get a Neeraj. Do stay on, Jonathan. We want to get a Neeraj Diwan, Director of Quantum Securities, on the show now. Neeraj, markets tend to overreact, right, on both sides, on the way up and on the way down. They first sell and then they find reasons, justifications, and that seems to be what's happening right now. In the sell-off, have you made any purchases? Would you recommend any buys? Are any stocks which you were looking at earlier now available with the cut that we've seen?
Yeah, good afternoon. Yeah, actually, the way things have happened has been pretty fast over the last week, and now early this week, today, the kind of sell-off that we've seen. I think that because there's a first day of a major fall, I think one can wait for a day and see what kind of noises you hear from US, whether there's a contagion effect or not, whether Fed does some make some statement which will cool the market. I think it's better to wait for a day, though definitely I feel you are getting opportunities. You saw India infrastructure space doing so well. So infrastructure, capital good was a space where you were seeing so many investments happening, and there you have a good potential for a good EPS upgrades also there. So I think you're getting opportunities there, but I think I'll rather today we're not really buying anything and waiting for a day or two to see how things pan out from here.
Okay, so wait and watch. By the way, the market has recovered quite a bit from the lows, that is. 224 points or so lower is what you have. And I think we were at 17,114. The market now at about 17,188 or so. Nimesh was telling us earlier on D Street Chatter that there is no, he did not get the sense that there is a large amount of institutional FI selling or and such. So let's see. I think those figures will be important. Jonathan, for a market like India, there was FIs were anyway selling, right? There was this move out of the best performing market of 2022 into the least performing markets of 22. So India into China and other markets. So no real change. Is it at the margin? Is it a continuation of the same? And of course, all of this on the side does not help.
No, absolutely. I think as you rightly point out, that's been a trend that's been going on for a few months now, particularly since China announced their reopening late last year. If you look at the sort of levels, I would say probably most of that trade has happened. We've still probably got a little bit further to go. India has been such a strong performer. I guess the other thing to point out would be the financial sector in India is very strong. There's some very, good private banks, not much exposure overseas, great domestic stories for all those companies. So, yes, there could be a little bit further risk off and India potentially could come off a little bit, but I think certainly FIIs will begin to start looking at this market again as the valuations have come off.
Okay, all right. We will have to take a break on that note. We will come back in just a bit and keep tracking what has turned out to be a pretty savage market fall. Back in just a moment.
Okay, welcome back. You're with us here on Closing Bell, and we are closing now. So 2 minutes to go for the bell to go. And we're I mean, I wouldn't say it's respectable, but it's a decent bounce from the lows. We were down 300. We'll end about 220 odd points down for the day. The Nifty Bank also, but banks, of course, selling off more, 2%, 850 points lower. Neeraj, thank you very much for staying with us. Appreciate your time and see you back soon again. All sectoral indices in the red today, and of course, banks taking it in the worst possible way. 3% of the PSU Bank index. You had the small cap index, which was down about 2.25%. Private bank index, which was down about 2.25%. Autos, which were down about 2% as well. Bank Nifty itself down 2%. Both the Nifty and the Bank Nifty, I think, ending below the February lows. Actually, the Bank Nifty just a smidge above the Feb lows. 39,640. The low is 39,600. So it closes at the Feb lows. The Nifty, of course, closes below the Feb low of 17,255. Prima.
The midcap index underperforms today. The midcap index goes home with a cut of 2%, but it's about 2% higher than its February low. The advanced decline ratio was dismal, one stock in the green for 6 in the red. Running you through some of the big losers: IndusInd Bank, the top sectoral loser, top Nifty loser, 7.5% down. Other banking names like State Bank of India, Axis Bank under pressure. Reliance Industries, 1.5% knock. Autos was one of the big drags today. Tata Motors, M&M in reverse gear. IT stocks lost ground. Not just Infosys, which lost Mohit Joshi, but even the other names like TCS, HCL Tech selling off. The only gainer, in fact, 4 Nifty stocks out of 50 stocks closed in the green, but the top honors goes to Tech Mahindra after they managed to get Mohit Joshi on board. Quite a coup.
Oh, absolutely. Just very quickly, some newsmakers as well. Most of them in the red. Mahindra CIE and Sona BLW, because there were 2 big block trades on these 2 stocks, between 6 and 7% down on both of them. Yes Bank, where the lock-in for the key lenders has ended today, 5% down there. ACC and Ambuja have ended negative from the Adani group, but a lot of other Adani stocks were positive, like Adani Power, Adani Green, and Total Gas. They were positive. Nazara has ended flat, so not a bad show, considering the exposure they have is fairly minuscule, just about 64 odd crores. Those were some of the major movers and shakers. Other than that, of course, anything in financials, anything and everything, whether you're looking at Aditya Birla Capital or you're looking at smaller names like a South Indian Bank, basically down and out. Max Financial absolutely beaten black and blue if you were a financial name, bank or NBFC. That's the show for today, and we are ending at 17,187 with a cut of 225 points.
With that, it's a wrap on this edition of Closing Bell, but don't go anywhere. Our special market sell-off comes up next.